Welcome back to the deep dive. It is Friday, January 30th, 2026. And I have to say, the economic landscape out there feels a little bit like we are walking on a frozen lake that is just, starting to crack.
It definitely does.
Today, we are not looking at a tech startup, we aren't looking at AI, and we are not looking at crypto. We are looking at the absolute bedrock of the industrial economy, a giant, a petrochemical titan that is currently navigating what might be one of the roughest, deepest, and coldest storms in the history of the industry.
Yeah, that's not exaggeration.
We are talking about LyondellBasell, ticker symbol LYB.
And it is a fascinating morning to be looking at this company. If you just glanced at the headlines over your coffee this morning, you might be scratching your head.
Oh, absolutely.
You might even think there is a typo in the reporting. They just reported their fourth quarter earnings for 2025, and to put it mildly, the earnings report was a paradox wrapped in a riddle.
That is exactly why we are here. That is the mission for today's deep dive. We need to untangle this paradox. We have a company that just reported a negative earnings per share. They actually lost money on paper, quite a bit of it.
A lot of it.
And yet they are maintaining a dividend yield that is sitting at a massive 11%.
It's a high-stakes game, and the central question we're exploring is whether this is a value trap, a company spiraling down while paying you a little bit of, hush money to watch, or if this is a masterclass in financial engineering and survival.
Management calls it the bridge strategy. I call it burning the furniture to keep the house warm. But they seem to think the house is fireproof. They are acting like this is all part of some grand plan.
I might push back on the burning furniture analogy just a little bit later on. I think it's less about burning the furniture and more about deep, calculated hibernation.
Hibernation, yeah.
They're building a liquidity fortress to outlast a winter that has dragged on much, much longer than anyone anticipated.
Well, let's unpack that, because winter is definitely the right word. Before we get into the strategy, and we are going to get into the layoffs, the asset sales, the pivot away from green energy, all of it, we have to look at the numbers that dropped this morning.
Absolutely.
This is the Q4 2025 paradox we were talking about.
Right. Let's start with the headline numbers. Wall Street was expecting a profit. Not a huge one, mind you. The analysts know the sector is in a trough.
Sure, expectations were low.
Exactly. They were looking for earnings per share, or EPS, of positive $0.18. Just a modest profit to show they can keep their heads above water.
Okay. 18 cents.
Instead, LyondellBasell came in with a loss of 26 cents per share.
A loss. Whoa. That is a miss by a mile. That's a 44-cent swing. In the world of penny-pinching industrial stocks, that is usually the kind of thing that sends a stock plummeting 20% at the opening bell.
Usually, yes. If this were a growth stock, it would be down 50%, no question. But then you look at the top line. Revenue came in at $7.09 billion.
So not all bad news.
Right. That actually beat expectations by about $270 million. But, and this is a big contextual but, revenue is still down about 25% year over year.
So let me get this straight. They sold more product than people expected, hence the revenue beat, but they lost money doing it. It sounds like the old joke, we lose money on every sale, but we make it up on volume.
That's not far off. It comes down to margins. The spread between what it costs them to buy the raw ingredients, oil, natural gas, ethane, and what they can sell the finished plastic for.
And those margins are just gone.
They're crushed right now. Industry margins are currently sitting about 45% below their historical averages.
45% below average, that is the definition of a depression in a sector.
It's the bottom of the bottom. So investors aren't panicking about the EPS miss because they know it's not necessarily an execution problem at LyondellBasell. It's an industry-wide depression. Everyone is bleeding.
I see.
The fact that they generated revenue shows they're moving product, even if the pricing power isn't there yet.
Okay, so everyone is suffering. But here's where it gets really interesting and, frankly, a little confusing for the average person looking at a balance sheet.
It really is.
You have this accounting loss, this negative EPS. You'd expect the bank account to be draining. But then you look at their cash flow statement, and it tells a completely different story.
Exactly. This is the cash flow anomaly. And if you want to understand why the dividend hasn't been cut yet and why the stock is holding up, this is the only number that matters.
So what's the number?
Despite losing money on paper in Q4, for the full year of 2025, LyondellBasell generated $2.3 billion in operating cash flow.
Wait. How do you lose money on the P&L but find $2.3 billion in the couch cushions? Is this creative accounting?
It's not creative accounting, it's aggressive balance sheet management. It's all about cash conversion. And specifically, it's about liquidating working capital.
Break that down for us. Working capital release. It sounds like corporate jargon.
It does, but it's simpler than it sounds. Think about it this way. You run a massive store. You have shelves stacked to the ceiling with product, in this case, plastic pellets, polyethylene, polypropylene.
Okay.
That inventory costs you money to make. You paid for the raw materials, you paid the workers, you paid the electric bill. But as long as it sits on the shelf, it's just an asset. It's not cash. It's money trapped in plastic.
Okay, so I have a warehouse full of money trapped in plastic.
In Q4, LyondellBasell decided to stop making as much new plastic and focus entirely on emptying that warehouse. They sold off the inventory.
So they just sold what they already had.
Exactly.
Yeah.
When you sell inventory without replacing it immediately, you release cash. That money flows back into the bank account.
So they are liquidating. They are having a clearance sale.
Aggressively. In the fourth quarter alone, they released over $1 billion from working capital.
$1 billion in 3 months.
$1 billion. And that includes selling off inventory and also aggressively collecting on their bills, their receivables. They went to their customers and said, pay us now.
So that $1 billion shows up as cash coming in the door, but it doesn't show up as profit because the cost to make that stuff was incurred previously.
Precisely. It distorts the cash flow picture in a positive way.
Right.
Their cash conversion ratio hit 95%. Their target is usually 80%. They are squeezing every drop of liquidity out of the machine.
It's almost like they're squeezing blood from a stone. But here is the catch, and this goes back to my burning furniture point. You can only empty the warehouse once. Right.
That's the key.
Eventually, the shelves are bare. You can't run a business on working capital release forever.
That is the danger. It is a finite lever, the one-time trick or a few times trick. You can do it for a few quarters, maybe a year, but you cannot sustain a company this way for 5 years.
For now.
For right now, it has served its purpose.
And that purpose is what? Building a wall of cash.
Building the liquidity fortress. Because of that squeeze, they ended 2025 with $3.4 billion in cash and short-term investments sitting on the balance sheet.
$3.4 billion. That is a lot of dry powder.
Yeah, it is. And if you add in their revolving credit lines, essentially their corporate credit cards that they haven't used yet, they have total available liquidity of $8.1 billion.
Wow.
So even though the profit and loss statement looks ugly, the bank account is actually quite full. They have a massive war chest to defend themselves against this downturn.
Okay, so they have the cash for now. But they are treating this cash like it's oxygen in a submarine. They are trying to make it last.
Yes, and that brings us to what management is calling the bridge strategy.
Right, the bridge strategy.
Management says this is about controlling the controllables, which is a phrase I always hear when executives realize they have absolutely zero control over the market price of their product.
It translates to, we can't fix the economy, so we are going to fix ourselves.
It's survival mode, pure and simple. The goal is to build a bridge from today, where the market is terrible, to the cycle turn, which they expect in late 2026 or 2027.
And they have to build that bridge with two very important conditions.
Yes, without cutting the dividend and without losing their investment-grade credit rating.
That is a tightrope walk. You have to save enough money to pay the shareholders, but not cut so much that you destroy the business. So what are the pillars of this bridge? How do you save that much money?
They have 4 main levers they're pulling. And when you look at them together, you realize just how drastic this self-help program really is.
Let's get into it.
The first lever is the cash improvement plan.
That sounds nice. Cash improvement. Who doesn't want that?
It's the efficiency bucket. Management originally targeted $1.1 billion in recurring savings by the end of 2026. They've looked at their progress, looked at the market, and said, we need to go deeper.
So they're increasing the target.
They bumped that target up to $1.3 billion.
And are they actually hitting those targets, or is this just a PowerPoint slide to keep the investors happy?
No, they're crushing them. They had a goal to save $600 million in 2025. They actually saved $800 million. So they're finding efficiencies everywhere: supply chain, procurement, logistics.
But efficiencies usually mean something else when you read between the lines. When a company says they found $800 million in savings, it usually means people are losing their jobs.
It does, and that is lever number 2, workforce reductions. This is the human cost of the bridge strategy, and we shouldn't gloss over it.
What are the numbers?
In 2025, LyondellBasell reduced their global headcount by 7%.
Wow. 7% of the global workforce.
That is about 350 employees gone.
That is significant.
It is. It brings their staffing levels down to the lowest point since 2018. They are running a very, very lean ship.
That explains the burning furniture feeling. You're cutting bone at that point. If you cut 7% of your staff, are you losing the people who know how to run the plants safely? Are you losing the people who know how to innovate for the future?
That is the risk. That
Yeah.
is the bear case, absolutely. That they are hollowing out the organization to save a few quarters of dividends. Management, of course, argues they are becoming leaner, flatter, and more agile.
The classic corporate line.
They say they are removing layers of bureaucracy. But there is no doubt everyone left at that company is doing the work of 1.1 people, maybe more.
Let's look at liver 3 because this reinforces that hollowing out fear, the CapEx/capital expenditure.
This is the money you spend to fix plants or build new ones.
Yeah.
For 2026, they have cut their CapEx budget to $1.2 billion.
Put that in context for us. Is that a lot? A little.
It is a severe tightening. Their historical norm is around $2 billion a year.
So they've almost cut it in half.
Pretty much.
Yeah.
And if you look at the breakdown, it's even more stark. $800 million of that is just for maintenance, keeping the lights on, keeping the pipes from leaking, safety compliance.
So that's just the cost of doing business.
Exactly. That leaves only $400 million for growth.
$400 million for a company with $30 billion in revenue, that's basically zero. They have stopped growing.
They are in maintenance mode. Essentially, they have pressed the pause button on the future to survive the present.
And there's a specific example of this that's really telling. We call it the Houston move.
Yes, this was a major decision. They shut down the Houston refinery. Now, refining is a tough business, and they had been trying to exit it for a while.
Right, this wasn't a total surprise.
But the timing was critical. By shutting it down when they did, they avoided an estimated $1.5 billion in necessary turnaround CapEx.
Explain turnaround costs for the listeners who might not be in the industry. It sounds like they just turned off the lights. It's more complicated than that.
Oh, much more. In heavy industry, a turnaround is like the major 100,000-mile service on your car. But for a massive chemical plant, every few years, by law and by necessity, you have to shut the plant down completely.
Take it all apart.
You take it apart, you clean the reactors, you replace the worn-out steel, check every valve. It is incredibly expensive and labor-intensive.
So they looked at a $1.5 billion bill to fix up the refinery and said, you know what, let's just close it instead.
Exactly. It was a defensive move to avoid spending cash. Why spend $1.5 billion fixing an asset that isn't making much money? It makes financial sense. But it also means the company is physically smaller today than it was yesterday.
They are shrinking to survive.
Precisely.
And that brings us to lever number 4, which I think is actually the most controversial and arguably the most significant shift we're seeing in terms of corporate philosophy.
A sustainability pivot.
Yes. For the last 5 years, what has every chemical company been shouting from the rooftops? ESG, circularity, green polymers. We are going to save the planet.
It was the only thing they talked about. Green at all costs. Every presentation with green leaves and blue skies.
LyondellBasell just pumped the brakes. Hard. Management explicitly stated in the earnings call that they are limiting investments in circularity and sustainability.
That is a bold thing to say in 2026. The regulators aren't going to like that. The ESG funds are not going to like that.
It's almost taboo to say that out loud.
It is. They clarified that they will now only fund immediately profitable green projects.
What does that even mean? Immediately profitable?
It means if the project doesn't make money today, it gets cut. No more R&D science projects that might pay off in 2030. If it doesn't have a positive return on investment right now, it's on the chopping block.
So the dividend is more important than the energy transition right now.
In the short term, absolutely. They are prioritizing the payout to shareholders over long-term positioning in the green economy.
From a business perspective, I guess I get it.
From a survival standpoint, it makes sense. Cash is king. But if you look 5 or 10 years down the road, this puts them at risk.
How so?
If their competitors, companies like Dow or BASF or the big Chinese firms, keep investing in green tech while Lyondell pauses, when the market eventually shifts to a 100% green requirement, whether by regulation or consumer demand, Lyondell will be playing catch-up.
They could be the dinosaur.
They could. They're betting they can be a fast follower, leader, when they have the cash. But for now, the green projects are on hold.
So you have aggressive savings, you have layoffs, you have a slash in spending, and you have a pivot away from green projects.
Correct. All to keep that cash pile high enough to pay the dividend.
Okay, so that's the strategy at the corporate level.
Yeah.
It's austerity. It's painful. Let's zoom in a bit and look at the actual business segments, because LyondellBasell is a global beast, and not every part of the world is performing the same way.
No, it's a tale of two regions, really. You have the Americas, and then you have EAI Europe, Asia, International, and the story couldn't be more different.
Let's start with the home turf. Olefins and polyolefins Americas. How did they do?
They posted an EBITDA of $164 million. That's down, obviously. But considering the headwinds, it represents a certain amount of resilience.
What kind of headwinds?
They had higher feedstock costs, ethane and natural gas got more expensive. And then, of course, there was Winter Storm Fern.
Right, the storm. I feel like every year now we have a named winter storm that shuts down Texas. Usually bad weather is bad for business. Plants shut down, pipes freeze, you lose production.
It is bad for operations. It's a headache for the engineers, no doubt. But in the petrochemical industry, there's a weird, counterintuitive silver lining to these disasters.
A silver lining to a blizzard.
The storm forced a lot of capacity offline, not just for LyondellBasell, but for everyone on the Gulf Coast.
So supply got tight?
Critically tight. Industry inventories for polyethylene dropped to about 40 days of supply. That is historically very low. So, weirdly enough, the storm gave LyondellBasell leverage.
Explain that leverage.
Because supply is so tight, customers are scrambling for product. When customers scramble, you can raise prices. LyondellBasell is using this tightness to push through price increases in Q1 2026.
Supply and demand in action. The storm breaks the supply chain, prices go up, and if you have inventory to sell, remember that warehouse we talked about? You make more money.
Exactly. They're currently running their plants at about 85% capacity to match that demand. So the Americas are struggling with costs, but the pricing power is coming back. It's the petro paradox. Sometimes a disaster saves the quarter.
Now let's look across the pond. Europe. Olefins and polyolefins, EAI.
This is the problem, child. This is where the real pain is.
What are the numbers here?
EBITDA came in at a loss of negative $61 million.
Ouch. They're losing money on every ton of plastic they make in Europe.
Europe is just tough. It might be fundamentally broken for this industry. Energy costs are structurally higher. Their natural gas is expensive. And they are getting hammered by cheap imports coming from other parts of the world. It's a very difficult place to make plastic right now.
But management has a solution for this, right? They aren't just sitting there taking the losses. This brings us back to the bridge.
Yes, they are divesting assets. They have a deal on track to sell 4 major European assets. They expect that to close in Q2 2026.
That feels like the light at the end of the tunnel.
It is massive. The strategic importance cannot be overstated. Selling these assets does 2 things. First, it stops the bleeding. You get rid of the units that are losing $61 million a quarter.
You literally cut off the infected limb.
Exactly. And second, you get a lump sum cash infusion from the sale. We don't know the exact final number yet, but it will be substantial. That cash goes straight into the liquidity fortress.
So Q2 2026 is a critical date. If that sale falls through, if the European regulators block it or the buyer walks away,
that would be catastrophic. The bridge might collapse.
Right.
The cash assumptions of the whole strategy rely on that sale, but management says it's on track.
Before we move on to the dividend math, which I know is the main event here, was there any good news in the segments? Or is it all doom and gloom in selling assets?
There was one bright spot, a hidden gem, Advanced Polymer Solutions, or APS.
APS, what do they do again?
These are the high-end specialized plastics. This isn't the stuff that makes milk jugs or garbage bags. This is the stuff that goes into automotive dashboards, healthcare devices, high-performance coatings. It's the sticky high-tech stuff.
And how did they do?
EBITDA was up 55% year over year. They hit $38 million.
55% growth in this economy. Did everyone suddenly buy a new car?
That's the funny thing. Volumes were actually down. Automotive demand is seasonal, and it was weak in Q4.
So they sold less product but made 55% more profit. How is that possible?
Pure cost discipline and mix management. They squeezed more profit out of every single unit. They stopped selling the low-margin stuff and focused only on the high-value stuff.
Wow.
It's a small part of the company compared to the commodity side. $38 million is a drop in the bucket compared to the billions elsewhere. But it proves that execution matters.
That is impressive. It shows that the self-help narrative isn't just talk. They're actually making operations more efficient where they can.
It does, but, and we have to pivot here, efficiency in a small segment doesn't fix the massive hole in the middle of the balance sheet.
Which brings us to part 4, the dividend squeeze. This is the red flag zone. This is why the listeners are tuning in.
This is what every investor is staring at. The yield is sitting at 10 to 11%. That is a siren song. It is tempting.
Yeah.
But we have to look at the math, and the math is scary.
Let's do the math. Nice and slow.
Okay. In 2025, LyondellBasell earned on an adjusted basis $1.70 per share.
Okay, $1.70 in the pocket for the year.
It is. And this raises the core question. Is the dividend safe?
Management seems to think so. CEO Peter Vanacker was on the call, and he was pretty firm about it.
He was. But you have to listen to the specific language he used. He didn't just say, yes, the dividend is safe. Absolutely. He said the investment-grade balance sheet is foundational.
Foundational, that sounds like a commitment.
It is a commitment. But notice the noun. He didn't say the dividend is foundational. He said the balance sheet is.
Ah, I see the distinction. He's talking about their credit rating.
Exactly. Analysts are interpreting this as a hierarchy, a priority list. Priority number 1 is the investment-grade credit rating. Priority number 2 is the dividend.
Why is the credit rating so important? Why not lose the rating to save the dividend for shareholders?
Because if they lose the investment-grade status, they become junk. If they become junk, the interest rates on their debt skyrocket. Their cost of capital explodes. For a capital-intensive business like chemicals, that is a death spiral.
So they can't afford that.
They cannot afford to lose the rating.
So if push comes to shove, if the downturn drags into 2027, or if that European sale falls apart.
If the board has to choose between losing their credit rating or cutting the dividend, the credit rating wins. The dividend gets cut. Every time.
So the dividend is safe for now because of the cash pile, but there is zero margin for error.
Zero. They are walking a tightrope without a net. The cash pile is the only thing keeping the dividend alive.
And investors are split on this rate. I was reading the comments on the investment forums, and it's a war zone in there.
It really is. You have one camp calling it a falling knife. They say the business is shrinking, the earnings are negative, and a dividend cut is inevitable. They think the stock is going to $30.
In the other camp, what do they see?
They see it as a deep value play. They say, look, they have $3.4 billion in cash. They can pay this dividend for 18 months easily. By then, the cycle will turn and the stock will double. They call it a coiled spring.
A coiled spring or a falling knife, and there's a specific price level everyone is watching.
$48.80. That seems to be the technical support level. If it breaks below that, the market is basically signaling that it doesn't believe the bridge strategy will hold.
Okay, so we've got the strategy, we've got the scary math, but for this bridge to actually reach the other side, the world needs to change.
That's right.
LyondellBasell can't save its way to prosperity. They need the market to recover.
We do. We need a recovery. And there are two big factors that will determine if that happens in 2026.
Let's talk about them. Factor number 1, global rationalization.
This is a fancy corporate euphemism for companies going bust.
Survival of the fittest.
Exactly. When prices are this low, the high-cost producers, the guys with old, inefficient plants, or the guys who have to buy expensive naphtha instead of cheap ethane, they start losing too much money. They hemorrhage cash. Eventually, they have to shut down.
And we're seeing that happen.
We are. CEO Vanacker threw out a huge number on the call. He estimates that 23 million tons of global ethylene capacity is currently being rationalized.
Rationalized meaning shut down.
Shut down or scrapped. Gone.
23 million tons. Help us visualize that. That sounds like a lot of plastic.
It is massive. To put it in perspective, that's more than the entire capacity of some major industrial countries. It's huge. When you take that much supply out of the market, the supply-demand balance shifts. Eventually, supply drops below demand and prices have to go up.
So LyondellBasell is betting that they can hold their breath longer than the other guys.
Yes. They are betting that their liquidity fortress allows them to survive while the weaker competitors die off. Then, when the market turns, they are the last man standing and they reap the rewards.
Brutal, but effective.
That's capitalism in a commodity cycle. It's not pretty, but it's how the market clears.
Now let's talk about the second factor, the China factor. And there's a new buzzword we need to learn here, anti-involution.
Yes, this is fascinating. And it's crucial to understanding the global market. Involution is a term that has become very popular in China recently. It describes intense, self-destructive internal competition.
Like a rat race.
Wuss. It's like a race to the bottom where everyone loses. Companies competing so hard, slashing prices so low that they destroy all value for everyone just to keep market share.
And the Chinese government is looking at this.
They are. They are saying this isn't healthy. They are considering policies to stop involution. They call it anti-involution.
So the government might step in and say, stop making so much cheap plastic.
Effectively, yes. They're considering policies that would force inefficient Chinese capacity to close. They don't want their industries burning cash just to keep factories running. They want sustainable, profitable industries.
And there's a tax component to this, too.
There is a new consumption tax on naphtha. Naphtha is a key raw material for making plastic in Asia. If China taxes it, it hurts their domestic producers. It raises their costs.
Which means they can't export cheap plastic to the rest of the world as easily.
Bingo. Right now, cheap Chinese exports are flooding the global market and crushing margins for everyone, including LyondellBasell. If this tax comes in and anti-involution policies bite, that flood of cheap plastic dries up.
And suddenly, LyondellBasell's pricing power returns.
That is the hope. That is the macro catalyst they are praying for.
So we have a clear picture now. Q1 2026 forecast looks like modest improvement. Seasonal demand is coming back in the spring. Supply is tight because of the storm.
The short term looks, okay, stable.
Mm-hmm.
But the long term depends entirely on that cycle turning by late 2026.
So let's wrap this up. We've looked at the autopsy, the strategy, the dividend math, and the macro outlook. What is the final verdict? Is LyondellBasell a hold, a buy, or a run for the hills?
I think it's a classic high-risk value play. I would label it a hold for now, but with your hand hovering over the sell button.
Explain the bull case one more time, the reason to hold on.
The bull case is that the bridge holds. The European assets sell in Q2, bringing in cash. The global capacity rationalization kicks in, China reforms its market, and margins recover by the end of the year. If that happens, you're getting an 11% yield plus capital appreciation. The stock could double from here.
A potential double.
Yeah.
And the bear case. The reason to sell right now.
The recession drags into 2027. The European sale gets blocked or delayed. The cash pile runs dry. The board looks at the credit rating and says, we have to cut. If they cut the dividend, the stock crashes.
It really is a binary outcome. It's going to go big one way or the other.
It is. Management closed with a quote, risk defined, portfolio protected. They believe they have ring-fenced the risk.
I want to leave our listeners with a provocative thought. We talked about burning the furniture. LyondellBasell is betting the farm on a recovery by late 2026.
They've put all their chips on that date.
They have cut staff, they have cut growth capex, they have sold assets, they are paying you to wait.
But here's the question. If the global economy doesn't cooperate, if we slide into a deeper recession, they will have stripped the company to the bone. They will have stopped investing in the future.
And they will eventually have to cut the payout anyway.
After all that pain.
So the question is, are you paid enough at 11% to take the risk that they might be wrong? Are you paid enough to catch a falling knife?
That is the question every investor needs to answer for themselves.
Indeed. It's a fascinating story of corporate survival, and we will definitely be watching that $48.80 price level. Thanks for taking the deep dive with us today. We'll see you next time.
Thanks for listening.